Welcome back to the Deep Dive. Our mission here is, as always, to take the complex financial sources you've shared with us, rip off all those layers of jargon, and deliver the clearest, most actionable insights directly to you.
And today we are stepping into territory that is rarely neutral. We're talking about debt.
Right.
For most people, borrowing money comes loaded with this emotional baggage. There's judgment, anxiety, maybe even a feeling of failure.
Right. We hear that all the time, that moralizing language. Good debt versus bad debt.
Mhm.
But if we strip away the emotion, what is debt really?
At its core, it is simply a financial tool.
A tool. A highly potent one, yes, but a tool nonetheless. And our deep dive today is focused on mastering the foundational principles of borrowing and strategic debt management, using this stack of source material as our absolute guide.
Our goal here is to equip you to manage that tool effectively, to put you back in the driver's seat rather than, feeling like you're constantly reacting defensively to your debt obligations.
Okay, so let's unpack the absolute necessity of it. Why do we even need this tool in the first place? I mean, our sources define the primary purpose of debt very, very clearly.
They do. It's used to finance goals when your available self-funding or, your existing savings are simply inadequate to cover the cost.
So you're leveraging your future income to secure an asset in the present.
Precisely. And the canonical example is housing. I mean, look at the cost of a home today.
It's astronomical.
It's typically so vast that if you, the individual, waited until you had enough savings to buy it outright, you likely wouldn't be able to make that purchase until you were near retirement age.
So borrowing, specifically through a mortgage, lets you bring that purchase forward by decades. It can immediately improve your quality of life, your stability, and potentially your net worth.
And when you use debt for that massive purpose, acquiring property, you are dealing with a mortgage. The sources have a very precise definition for this.
Which is?
A mortgage is a loan secured by a charge on the property itself. The property is the collateral.
That security element, that's fundamental to the entire system, isn't it?
It is. It dramatically lowers the risk for the lender, and that lowered risk, well, that translates directly into a lower interest rate for you, the borrower.
So you pay less for the privilege of immediate ownership.
Exactly. However, we have to start with the crucial caveat that anchors this whole discussion. Debt is never free.
Never.
It
Yeah.
always comes at a cost, which is the interest, and more importantly, it imposes a binding legal repayment obligation. That obligation is the non-negotiable core of all debt management.
Okay, so let's try to flip that common negative script.
Sure.
We often hear debt is a hindrance, it's something to be avoided at all costs, but strategically, the sources suggest it can be an accelerator, not a hindrance, especially when you're dealing with the timing of cash flows.
That is the essential shift in mindset we need to adopt here. Think of short-term debt as a kind of necessary shock absorber.
A shock absorber. I like that.
It can address temporary cash flow mismatches or unforeseen emergencies, and that allows you to maintain your current path without these sudden, really damaging disruptions. It keeps your life's continuity intact.
And this is where it gets really interesting, I think. When you connect borrowing with investments, the sources explore this concept of using debt to maintain the crucial compounding effect of your existing investments.
Yes. Let's run a scenario to make this clear. Say you have, I don't know, $50,000 growing comfortably in your retirement portfolio, compounding at, say, 8% annually.
Okay.
Suddenly, you need $50,000 for an immediate necessary expense. Perhaps it's for advanced education or a major home repair. Your choices are, 1, liquidate the portfolio, stopping that compounding growth dead in its tracks.
Or 2, you take out a loan, maybe at 6%. This strategic approach, and this is so counterintuitive, is often the loan.
It often is. An education loan, for instance, allows those existing retirement funds to just keep growing, leveraging time and compounding. You then use your future income, which is presumably higher because you invested in that education, to repay the debt at 6%, while your existing assets continue to climb at 8%.
So you've essentially bought time for your investments to grow using a temporary liability.
You've used leverage strategically.
Yeah.
And this leads us to a fascinating, if a bit complex piece of financial theory mentioned in our sources.
Modigliani-Miller theorem.
Yes, the M&M theorem.
It sounds intimidating.
It does, but in its purest form, the theorem suggests that in this perfect world without taxes or bankruptcy costs, the financial structure of a company, so how much debt versus how much equity it uses, it doesn't affect its total value.
Okay, so that's for a company. What does that mean for me? for my personal balance sheet.
Well, while we don't live in that perfect world, the principle carries a profound insight for personal finance, and it's all about leverage. It essentially suggests the efficiency of capital. If you have a specific return target, say, you need to acquire a property that you expect will yield a certain return, and the cost of borrowing that capital, the interest rate, is lower than the return you expect.
Then leveraging borrowed funds might actually increase the total return you make on the equity you personally invested.
Precisely. You are maximizing the use of every available dollar.
So M&M gives us this theoretical strategic potential of debt. It can enhance returns, but it's all based on one huge assumption.
That you can service that debt.
Right, that theoretical benefit just evaporates the moment you default. It takes us directly back to risk management. So if debt can be this powerful tool, what defines the practical, safe threshold for borrowing? How do you know when the risk outweighs the reward?
The determination is, on the surface, simple, but it is absolutely vital. The sole determinant for taking on debt is your household's ability to bear the additional charge of interest and the periodic repayment with its available income.
It has nothing to do with what the bank offers you.
Absolutely not. It's about what you can comfortably manage month in and month out.
Which brings us back to that core idea that debt isn't inherently bad. It has to be viewed in perspective based on what it finances.
Exactly. If it's a home, if it's enhancing a skill through useful education, these are often seen as necessary steps toward future financial well-being. But if the debt is financing something that doesn't appreciate or increase your income, your risk tolerance has to shrink immediately.
I have to challenge that education loan idea just a little bit, though. I mean, the math works beautifully if the return is higher than the interest, but what happens if the career doesn't pan out or the return is delayed for years?
That is a crucial point.
Isn't advising someone to take on, high-cost debt based on a future income a massive gamble?
It can be, and that's why our sources are so careful to emphasize the education nuance. If that education investment doesn't significantly enhance future income potential, then the debt is structured on, well, fragile hopes.
So the strategy is only sound if the expected income jump is highly probable.
Highly probable and sufficient to absorb both the principal and interest repayments comfortably. Without that confidence, you're just using expensive debt to buy something that acts more like consumption than an investment.
Okay, so moving from the theoretical strategy to practical day-to-day control. We have to talk about the one metric that lenders care about more than anything else.
The debt-to-income ratio, the DTI.
The DTI. This is the indicator that measures your ability to meet debt obligations using your available income. For lenders, this is the primary risk filter.
And while there's no single global legal standard for DTI, the sources all confirm there is a universal lender consensus.
Which is?
A lower DTI is always better for loan approval and for securing the most favorable interest rate. It speaks directly to the scope of your financial stability.
Let's put some real numbers to this to make it actionable for people. How is it calculated?
It's actually pretty simple. You take your total monthly debt payments, and that includes the proposed new loan you're applying for, and you divide it by your gross monthly income.
Yeah. Your pre-tax income.
Your pre-tax income, yes. For approval, many lenders, they really want to see a DTI below 36% and almost certainly below 43%.
But let's analyze the danger zone that our sources define. They say a 50% debt servicing ratio is considered simply too high. That's the critical threshold of financial precarity. Why that specific number?
Because if half of your available income is going straight out the door just to service liabilities, your mortgage, car payments, credit cards, that severely restricts your cash flow.
Let's imagine you earn $5,000 a month.
And immediately, $2,500 of that is gone just for debt.
That leaves you with $2,500 to cover everything else. Rent or mortgage if it's not in there. Utilities, food, transportation, healthcare.
It's not enough. That number severely affects your ability to meet necessary expenses, provide for genuine emergencies, which will, inevitably happen, and most critically, it leaves literally nothing for future investment or long-term savings goals like retirement.
You're financially vulnerable. You're living on a razor's edge.
You really are. And this ratio is heavily influenced by market conditions. We've all seen how higher interest rates and larger loan amounts directly increase that monthly repayment pressure on your cash flow.
So if rates just tick up even slightly, a 50% ratio can quickly jump to 55%.
And that can push you into a genuine crisis, which is precisely why the source material emphasizes this scope to borrow principle.
Okay, the scope to borrow principle. Unpack that.
Keeping your debt servicing requirements low, say comfortably below 30%, it ensures you have scope or, financial headroom to borrow if a genuine crisis occurs on another front.
Like a sudden medical event or a job loss.
Exactly. You want leverage to be available as a true safety net, not something you are constantly struggling just to meet.
And to maintain that scope, that headroom, we have to look at the other side of the equation.
The spending side.
Right. We need to distinguish clearly between consumption expenditure and investment expenditure. This is often where households, I think, fall into debt traps.
It really is. So let's define them. Consumption expenditure is money spent without creating an asset or generating future income.
So things like dining out, new clothes, streaming services, recurring salon appointments, they're part of life quality for sure.
Of course. But once that money is spent, it's just gone.
In contrast, you have investment expenditure.
And this is money spent that creates an asset capable of generating future income or appreciation. Think of buying a diversified bond, investing in a rental property, or, as we discussed, that specific type of education that tangibly increases your career earnings.
And while we hit on the education nuance earlier, it really does bear repeating.
It does. For your financial health, education is only a useful investment when it actively helps you upskill and increases your future income-generating ability.
So if you incur debt for like a MOBI course or a low-return degree, it's not an investment.
It moves right into the consumption category, and that makes the debt you took on for it structurally weaker.
This is often the role of a financial advisor, right, to point out these things.
Yes. To highlight how specific, avoidable lifestyle expenditures, that constant consumption, might be actively preventing a family from fulfilling their critical long-term financial goals, you have to see the trade-off clearly.
So if you spend, say, $500 a month on discretionary consumption,
That's $6,000 a year. That is not reducing your mortgage principal or going into your retirement account.
absolutely. And seeing that trade-off requires deliberate control, which brings us to budgeting and course correction. The sources strongly advocate for a very prudent habit,
The income minus savings equals expenses approach.
which is the reverse of what most people do.
Most people do income minus expenses equals whatever is left for savings, which, as we know, is often zero.
Or less than zero.
Or less than zero, right?
Yeah.
The income minus savings model forces you to prioritize saving first. You're essentially paying yourself first, and then you only spend what is genuinely left over. This is non-negotiable for long-term financial health.
And this is where we start to identify the budget holes.
Right, and they usually stem from a few common mistakes. Mistaking discretionary spending, your wants, for essential expenses, your needs, failing to pay yourself first, and critically, failing to accurately track regular expenses.
Especially the small ones. They add up.
They really do. The sources suggest a fantastic actionable tip here. Note down all expenses above a modest daily limit. Whatever feels modest to you, it could be $5, 10 euros.
Let's call that the lost opportunity cost check.
I like that.
Because if you spend $7 on a gourmet coffee every workday, that's $35 a week. Over a month, that's $140.
And when you summarize these small expenses at the end of the month, you suddenly recognize that $140 was a lost opportunity to save.
And if that $140 was invested monthly for 30 years at a 7% return, it would be well over $170,000.
That latte was not just a latte. It was a significant chunk of your future security. And that tangible connection between daily behavior and long-term consequence is what good budgeting is all about.
There's another powerful technique mentioned, zero-based budgeting.
Ah, ZBB. Yes.
So instead of just tweaking last month's budget, which often means you just carry over waste.
You start from scratch, from zero. You think through every single expense you plan to have, and you have to justify its necessity. If you can't look at an expense and say, I absolutely need this to meet my core goals, it goes.
That sounds incredibly intense.
It is, but it's a powerful financial audit.
Okay, and finally, windfall management. You get a bonus, a tax refund, some kind of unexpected gain.
A healthy portion of that must be set apart for the future or, crucially, used to prepay outstanding high-interest loans. Don't let a bonus just finance new consumption.
And the sources warn against the most dangerous habit here.
Relying on regular windfalls.
Yes. If you start structuring your standard monthly budget around the expectation of a year-end bonus to cover your debt gaps,
You are encouraging wayward financial behavior. Because if that windfall doesn't materialize 1 year, you are immediately plunged into a much higher, unanticipated debt trap. Okay, we need to shift gears a little bit into the nuts and bolts of borrowing now. To manage debt, you have to understand the hierarchy of debt purpose and its cost. Structurally, not all liabilities are created equal.
Right. So ideally, debt should be used for acquiring appreciating assets,
Mm.
things like real estate, purchases that tend to increase in value over time.
And hopefully they increase in value faster than the cost of the interest, resulting in a positive net return for you.
The red flag, though, is using debt for highly volatile, high-risk endeavors. Our sources specifically flag margin financing for stocks.
Margin financing. So that's borrowing funds from your broker to invest in the stock market. Why is this structurally so high risk?
Because you've magnified the outcome, both the positive and the negative.
Exactly. If the market value of your investment falls, you still owe the original borrowed amount plus all the interest. So a 20% drop in a stock price might actually translate into a 40% loss on your leveraged capital.
Price volatility coupled with leverage is incredibly dangerous.
And it often leads to what are called margin calls, where the broker demands you put up more money or they sell your stocks at a loss.
And the absolute crisis point.
When a person starts borrowing to finance regular daily living expenses,
The source material is unequivocal about this.
yes, borrowing to cover recurring costs like groceries or utilities is the clearest possible indication that a person is living beyond their means and needs immediate course correction.
Okay, let's compare the cost structure of different loans. Secured loans.
Those are loans backed by an asset, like a house, gold, property. They're cheaper because they provide collateral. If you default, the lender can recover their money by taking the asset.
And conversely, unsecured loans.
Yeah.
Things like personal loans or credit cards.
They're based only on your personal guarantee, your promise to pay. And because of that higher systemic risk for the lender, they are very, very expensive.
And the ultimate expensive debt trap.
Revolving credit on a credit card.
Revolving credit. That means carrying a balance from one cycle to the next without paying the full statement amount.
Yes, and this results in truly exorbitant interest costs. We see them cited globally in the 30 to 45% annual percentage rate range.
That kind of interest rate just destroys wealth. It's almost impossible to get ahead.
It is. And understanding the structure of repayments is critical to avoiding this trap. We have to talk about amortization and loan tenor.
Amortization. That's the systematic process of repaying the borrowed capital and the interest over time through fixed payments. In many places, they're called equated monthly installments, or EMIs.
And the most crucial concept to grasp here is the interest capital shift.
Okay, what is that?
Your early EMI payments are heavily weighted towards interest. Why? Because the bank calculates the interest on the largest outstanding principal balance, which is right at the very beginning of the loan.
Let's illustrate this. Let's say you have a 30-year, $300,000 home loan at 7%. Your early monthly payment might be just under $2,000.
Right, say $1,996. For the first year of payments, maybe $1,750 of that monthly payment is pure interest.
So only about $246 actually touches the principal.
Exactly. The capital component only slowly increases over time as the principal gradually shrinks. The bank secures its profit right up front, and you only start making real headway on the capital years down the line.
And that shift, that's directly influenced by the loan tenor, right? The length of the loan.
It is. A longer tenor, say 30 years, it reduces your monthly payment, which makes the purchase seem more accessible. But extending that loan by even 5 or 10 years can significantly increase the total interest you pay over the life of the loan.
Often doubling the cost of the asset itself.
It can, yes. Conversely, a shorter tenor massively reduces the total interest you pay, but it increases the financial pressure through much larger periodic repayments.
So it's a direct trade-off between cash flow relief now and total cost later.
It is. And the sources briefly note some specific loan types. Home loans are long-term, 30 to 35 years. Vehicle loans are shorter, typically 3 to 7 years.
And on vehicle loans, there's a critical observation made.
Yes. Since a car is a depreciating asset, taking a loan for it actually decreases your net worth immediately.
The asset loses value the moment it drives off the lot.
But the liability, the loan plus the interest, remains fixed. It's a guaranteed way to reduce your net worth.
Okay, then you have personal loans, the most expensive unsecured option, used for any purpose. And for business, there's the overdraft facility.
Right. That allows a business to spend beyond its account balance up to a specified limit, and interest is charged only on the exact overdrawn amount, which makes it very flexible for managing working capital.
Diving into some operational nuances, fixed rate versus floating rate loans.
Fixed rates are predictable. They allow you to know the exact cost upfront. The rate remains constant regardless of what the market does.
Floating rates, on the other hand, change.
They change periodically based on an external benchmark, like a central bank's base rate.
And banks typically prefer floating rates, especially in a rising interest environment.
Of course they do. It protects their margins. If market rates move up, the bank can pass that cost immediately onto you, the borrower. For the borrower, floating rates introduce massive uncertainty and risk.
And when rates rise on a floating loan,
Yeah.
you generally have two choices.
Right. You can either increase the monthly EMI amount or you can increase the tenure of the loan.
And while increasing the EMI is mathematically smarter.
Increasing the tenure is often the easier choice emotionally and for your current cash flow, even though it will cost you significantly more in the long run.
Okay, for the listener who really wants to take forensic control of their loans, our sources point to specific tools, especially in spreadsheets. You need to know the function PMT.
Yes. PMT calculates the required fixed payment, the EMI, given the interest rate, the number of payments, and the principal amount. You should use this before you borrow to understand the monthly commitment.
But to truly understand that interest capital shift we talked about, you need two related functions.
PPMT and IPMT.
Right. PPMT calculates the principal portion of a given payment, and IPMT calculates the interest portion.
And by running these functions across every single month of your loan tenor, you can actually visualize that infamous curve. You can see for yourself exactly how little capital you pay down in those early years.
And that visualization is so key to making informed prepayment decisions.
It is. We also need to understand the rest period. This is a subtle but high-cost mechanism. It refers to the interest charging cycle.
So while you might pay your EMI monthly, the bank might only reset the interest calculation annually or semi-annually.
And an annual reset with monthly payments makes your effective borrowing cost higher than the quoted rate.
Why is that?
Because you don't get immediate credit for your monthly principal payment throughout the year. The interest charge for the entire year is calculated on a larger principal balance than what is actually outstanding after your first few payments.
So you always want a loan that offers a monthly rest period.
Always.
Yeah.
Finally, let's just quickly clarify the types of collateral that define how these secured loans operate. The distinction between a pledge, hypothecation, and a mortgage.
Okay, a pledge.
A pledge is when the movable asset, say gold, jewelry, or financial certificates, physically stays with the lender until the loan is repaid. You surrender possession.
Then hypothecation.
This is often used for movable assets that have to stay with you, the borrower, like a car or machinery or inventory in a business. You keep possession and you use the asset.
But the moment you default, the bank has the immediate legal right to repossess it.
Correct. And a mortgage, as we said earlier, is specific to immovable assets, land, and property, where the legal charge is placed on the asset, but you retain possession and usage. The distinction is all about physical possession and the ease of recovery for the lender.
Okay, now that we understand how loans are structured, we have to address the gatekeepers of low-cost borrowing, your credit score. This three-digit number can dictate your financial future.
The credit score is a crucial metric, typically ranging from 300 to 900, and it's assigned by a credit bureau based on your past credit behavior and your repayment history.
So it's a summary of how reliable you are as a borrower.
Exactly. And this score holds immense power. A high score doesn't just guarantee you'll get a loan.
It determines the interest rate you're offered, your eligibility for larger credit lines, and the overall limits you receive.
Essentially, a high score is the currency that grants you access to cheaper money. It can save you tens of thousands of dollars over a lifetime.
And conversely, poor behavior carries immediate and long-term consequences. We need to identify the factors that actively hurt the score.
The top offenders are pretty clear. Late payments. Maintaining high credit utilization, that means using too much of your available credit limit.
Right.
Taking on too many unsecured loans in a short period of time. And perhaps the least obvious one. Poor repayment behavior as a joint holder or a guarantor on someone else's debt.
That guarantor point is so critical. You might have impeccable financial habits yourself, but if you co-sign a loan for a friend or a family member who then defaults,
Their failure becomes your failure on your credit report. It's a shared liability that you absolutely must monitor closely.
so to manage the system, periodic monitoring is essential. The credit report itself, it's an exhaustive document, isn't it?
It is. It contains your score, details of every outstanding loan, and a comprehensive repayment history covering the last 2 to 7 years, depending on your jurisdiction.
And why is that periodic review so important?
To identify and rectify errors. Our sources emphasize that mistakes happen all the time.
Like what?
Incorrect loan closures might be reported, or wrong personal information gets attached to your file. If a bank reports a debt as unpaid when you know you settled it, you must challenge that immediately.
An accurate report is foundational to competitive borrowing.
It is, and here is a consumer protection insight that holds true globally. While the specific legal mandates vary, the core principle is universal.
You are entitled to at least one free full credit report every year from the major credit bureaus.
Yes, places like Experian, TransUnion, or Equifax. You should be leveraging that benefit annually to maintain control and ensure accuracy. Treating your credit report like an annual health checkup is just fundamental financial hygiene.
Okay, we've covered acquisition, mechanics, and scoring.
Mhm.
Now, for the crucial action phase, how do you strategically pay down debt once you have it? But first, we need a more refined lens for evaluating loan quality. It's not just about the interest rate.
Right. When you're comparing offers, our sources recommend 5 critical criteria. First, the obvious, the interest rate.
Okay.
Second, the reset period, as we discussed. A shorter reset period is better for you. Third, the total processing and legal fees, because those add to the effective cost. Fourth, the maximum tenure offered, which affects your flexibility.
And the fifth, if it's a floating loan, is the nature of the external benchmark that's being used.
Exactly. You want a benchmark that is transparent, widely used, and less prone to manipulation by the lender.
And you have to ensure the interest calculation method favors you.
Always. You must insist on the reducing balance method for interest calculation. That's where interest is only calculated on the remaining outstanding principal.
It's the consumer-friendly method.
It is. It results in a much, much lower final cost compared to older methods that calculate interest on the fixed original capital amount for the entire duration of the loan.
Another great consumer advantage mentioned in the sources. In many modern jurisdictions, regulators mandate no prepayment charges for standard home loans from banks.
And this is massive. It protects consumer choice. It allows you the freedom to close your debt early or switch to lower-cost providers to refinance without incurring significant penalties.
Okay, now for the great financial debate that divides experts and borrowers alike. Investing versus paying down debt.
Ah, yes. The mathematical answer is pretty straightforward.
Investing is mathematically superior if the expected long-term return on that investment, say, the historical average of 10 or 12% in a diversified equity fund, is significantly higher than your loan interest rate, say 7%.
In that scenario, you earn more than you pay. So
Yeah.
you should invest every extra dollar you have.
Right.
But here's where we have to acknowledge the psychological reality. Finances are never purely mathematical.
Right.
High loan burdens, especially those associated with credit cards or unexpected expenses, they cause real mental pressure. Paying them down, even if the pure math suggests you should invest, provides immense mental peace.
And that mental peace has an intangible value that has to be considered. It reduces stress, improves sleep, frees up cognitive space. It's the difference between pursuing the optimal mathematical outcome and achieving optimal psychological comfort and stability.
And this internal debate, it leads us to the 3 primary repayment strategies that govern debt management.
The first is the mathematical champion, the avalanche strategy.
The avalanche strategy focuses on paying off loans with the highest interest rates first, regardless of the balance size. You list out all your debts, you find the one with the biggest rate, that 42% credit card, and you throw every single extra dollar at it while paying only the minimums on everything else.
The benefit is clear.
Yeah.
It reduces your total interest burden the most. It saves you the maximum amount of money over the long term.
Our analogy for this is putting out the hottest fire first. It saves the most property, or in this case, the most interest. It's pure efficiency.
Then we have the psychological champion.
The snowball strategy.
The snowball strategy focuses on paying off the lowest debt amount first. You tackle that small credit card balance or the smallest personal loan, regardless of its interest rate.
The key benefit here is all about motivation. You get quick wins.
Right.
And once that small debt is paid off, the money you are using for its payment gets rolled over and added to the payment for the next smallest loan. This creates this immense motivational momentum. It picks up speed like a snowball rolling downhill.
The analogy for the snowball is clearing the small puddles first. It makes the floor look cleaner faster, giving you that immediate psychological lift and the energy to tackle the big flood later. It's essential for people who feel overwhelmed by debt.
And finally, we have the hybrid solution. The blizzard approach.
The blizzard approach.
It's a mixture. You start with the snowball approach to get that initial motivational boost, clearing 2 or 3 small debts quickly. And then you switch strategically to the avalanche strategy for maximum long-term savings once that psychological hurdle has been cleared.
It marries emotion and efficiency in a realistic way.
It really does. Now, moving on to the tools of debt restructuring. What happens when you're already struggling?
The first step in any rescheduling plan is to rank your debts by cost and deal with the costliest first.
Which, as a rule, are always your credit cards and personal loans. A fantastic tool for this is the credit card balance transfer.
This is a specific form of refinancing, right?
It is. You take out a lower cost loan, maybe a line of credit or a new card with a 0% introductory rate, to immediately pay off that exorbitant 42% credit card debt. You're using cheap money to kill expensive money.
You're buying yourself time to pay it down before the lower rate expires.
Exactly. Now, if you are in genuine financial distress and you're facing default, a bank may allow loan restructuring. This involves changing the conditions of the existing loan.
How so?
Perhaps reducing the EMI or significantly increasing the tenure just to help you avoid an outright default.
But be warned, restructuring is not a free pass.
Not at all. It often carries a cost. It may hurt your credit history or score because the bank is acknowledging you couldn't meet the original terms. That can increase the cost of your future borrowing. It is a lifeboat, but one that comes with a price.
And extreme cases of distress, the sources mention a haircut.
A haircut. This is when a lender agrees to accept a lower amount than what is actually owed, thereby reducing the total debt burden for you.
This usually only happens when the alternative for the bank is total default and the high cost of legal recovery.
Right. The bank essentially cuts its losses, and while this provides massive relief to the borrower, it will severely damage their credit score, making traditional borrowing very difficult for years to come. #outro.
Wow. This deep dive has spanned the entire life cycle of debt, from the theoretical decision to borrow all the way to the mathematical and psychological strategies of repayment. We hope you now see debt not as a moral failing, but as a strategic tool.
We've tried to arm you with the core tools, understanding how that DTI ratio governs your borrowing potential, dissecting amortization with those essential Excel functions, leveraging your right to a free annual credit report to protect your future borrowing power.
And choosing the right repayment strategy for you. Avalanche for cost reduction or snowball for motivational speed.
And the fundamental rule that anchors all of these strategies, it remains responsible borrowing. You should never borrow more than you can afford and should only buy what you can comfortably pay for based on your current income.
If you have to sacrifice necessary expenses or eliminate your savings just to meet the repayment obligation, the purchase is simply beyond your means.
And that leads us to our final thought for you to chew on this week, connecting the core tension of this entire deep dive math versus motivation.
We mentioned earlier that when you take a loan for a non-essential depreciating asset, like a new car, your net worth actually decreases immediately.
Right, because the total liability, the loan principal, plus all the accrued interest remains, while the asset itself loses value every single day.
So this raises a provocative question. If the pure math of borrowing for a non-essential depreciating item guarantees a negative net worth outcome, should the decision to borrow for such purchases be dictated strictly by mathematical logic, meaning you should never do it?
Or should the psychological fulfillment, the convenience, and the perceived status of that purchase sometimes be allowed to override the strict financial ledger? Where do you draw the line between comfort and cost?
We'll leave you to wrestle with that balance. Thanks for diving deep with us.
Until next time.